Hello students. In the previous video, I have shared only the classifications under the capital structure theories. We already know the capital structure theory is divided into two concepts. One is relevant and the another one is relevant. Why it is called relevant means the value of the firm gets affected because of your capital structure decision. And what is irrelevant means whatever your capital structure decisions, it doesn't goes to affect the value of the firm. So under relevant, there are two approaches. One is net income and the traditional approach, and the irrelevant again classified into two approaches, that is net operating income approach and approach. Now let's see deep into the net income approach. So this approach was suggested by David Duran. So what he states means that the capital structure of any given firm creates an impact on the value of the firm. So whenever you're changing your capital mix or financial mix, that is the equity or the debt proportion, it going to affect your value of the firm. That's what David Duran states under the net income approach. So hence the debt equity ratio of a firm affects your value of the firm and also the prices of your stock, prices of your shares. So mainly how it's going to affect your value of the firm, whether it's going to increase or whether it's going to decrease, anyway it's going to affect. Maximum, what net income approach says means whenever you are using your debt content in your capital structure, it increases your value of the firm and declines the overall cost of capital. Your cost of capital will be comes down. If your cost comes down, automatically you will be return will be at maximum, right? So you always the company, what's their aim is they have to minimize the cost, they have to decrease the cost. So better the financial manager can approach this net income approach to have a decrease or to have a low level in the overall cost of capital. Because of that only the company can use net income approach. So whenever your debt is increased, so overall cost of capital, it's nothing but the weighted average cost of capital will decrease and your value of the firm and your per share of a price, per value of a per share will also increase. So that was the argument under the net income approach. So what's the argument means? When your company increases your debt proportion, automatically the value of the firm will increase and the overall cost of capital will decrease. That was the argument given by David Duran. So how capital structure has overall its assumption, like this NI approach also have followed few assumptions. The first is the capital employed. Whatever the amount you are invested into a business, that never going to be change. It will remain constant. And the second thing is there are no corporate taxes. No taxes are involved. And the next main assumption is KD and KE. Always KD is less than the KE. That is the cost of equity in the NI approach. So whatever your debt and equity, whatever your capital structure decisions, the cost of debt and the cost of equity will never change. So whenever you are using of debt content, it doesn't going to change the risk perception of your investors. So that only it remains constant. Why it was remains constant means there is no change in the kind of risk perception of investors. Anyway, they're going to have a risk. We can't say that there is a 0% risk. Of course, whenever you are using your debt content in your capital structure, there is of course a financial risk, because you need to pay a interest will come under the financial risk. Okay, so the cost of debt and cost of equity remains constant. And the final assumption is, when you are increasing in financial leverage is nothing but the using of debt content in your capital structure more and more. When you are increasing your debt, that is the borrowed funds in your capital structure more, it doesn't going to affect your risk perception. Always there is a risk. So these are the main assumptions under the net income approach. And these are the formulas we're going to use for finding the value of the firm and the overall cost of capital under the net income approach. So V is nothing but the value of the firm. The main formula for V is equal to debt plus equity, that is expressed as D plus E. D is nothing but the market value of debt and E is nothing but the market value of equity. Yes, of course we know EBIT, that is the earnings before interest on tax. KO, that is the overall cost of capital, and also it called as a weighted average cost of capital. So KO is equal to EBIT divided by value of the firm. So if you have substitute with the values, you can get your value of the firm and the overall cost of capital, and you can apply the concept here under net income approach. So what was the concept under net income approach means, finally it will increase your value of the firm and decrease your overall cost of capital. So that was the main claim by Durand under net income approach. Let's see with the diagram. So the left hand side you can keep it as cost of capital, and the below you can define as degree of leverage, that is the debt content and the equity content. Okay, I said in the assumption KD and KE remains constant. So there was a straight line, there was no change in the cost of equity and the debt. What happens to KO? See here, from the top to bottom it was down, there was a curve. So from the overall cost of capital, it's decreased, it's shown in the decrease level. So KO is decreasing. So this was the diagram, can be expressed, it can show your NI argument. So in the NI approach, your value of the firm will increase and the overall cost of capital will decrease. And both cost of debt and cost of equity remains constant, and KO, it's nothing but the overall cost of capital, it's decrease. Okay, I hope you all understood about the NI approach, that is the net income approach, which was suggested by Durand. Thank you all.